In this lesson, how to trade the cup and handle pattern, the learning objectives are: you should understand how the rounding bottom pattern forms. You should know how to properly enter a trade using the rounding bottom pattern. And you should know the advantages and disadvantages of the rounding bottom pattern. The cup and handle pattern is the name of a chart pattern used in technical analysis that describes a bullish continuation trend or a bullish reversal. The reversal pattern occurs when the price is in a long-term downtrend, then forms a cup and handle pattern and reverses that trend, and the price starts rising. A continuation pattern occurs during an uptrend. The price is rising, forms a cup and handle, and then continues rising. In both situations, the pattern shows a period of bearish market sentiment before the overall trend starts in a bullish motion. The cup appears similar to a rounding bottom chart pattern following the rounding bottom. The price will likely enter a temporary retracement, which is known as the handle. You may have seen this in our last lesson because in the real world example towards the latter half of the video, you must have noticed that there was a small retracement. I was going to bring it up, but I didn't want to confuse you ahead of this lesson. But I'll say it now, that sometimes the handle can form a flag, pennant, or wedge pattern. Other times it trades sideways in a range. The handle is the final pullback before the big breakout. The smaller the handle, the more bullish the cup and handle pattern is. The handle needs to be smaller than the cup. The handle should not drop into the lower half of the cup, and ideally it should stay in the upper third. The pattern, which is the rounding bottom, should be in a U shape. You should avoid a sharp V shape because this then changes the pattern. The softer the U shape of the cup, the more it ensures that the cup is a consolidation pattern. As you practice and gain experience, you'll get better at recognizing and using this pattern. A cup and handle pattern can take place over any period of time. Some patterns emerge during day trading, forming over the course of hours, while others can take shape over the better part of a year. Often, price will remain at its low point for days, weeks, or even months before recovering. A cup and handle pattern consists of several candlesticks that form a U shape, which make up the base of the cup. There are two main ways to enter: an aggressive way and a conservative way. An aggressive way involves entering a trade when the handle forms. Doing this can maximize the likelihood of predicting a breakout while potentially minimizing risk. And a conservative entry means that you buy when the price breaks above the top of the channel of the handle. And when the price moves out of the handle, the pattern is considered complete, and the price is expected to rise. This is less risky compared to the aggressive entry strategy as the pattern is validated. However, it means that you reduce the amount of money you'll make. You should have a stop loss as well, because the price could rise a little and then fall. It could move sideways, or it could fall right after your entry. For this reason, a stop loss is always needed. A stop loss gets you out of a trade if the price drops after buying, and so it serves to control the risk on the trade if the price declines enough to invalidate the pattern. So it would be best if you place a stop loss below the lowest point of the handle, because if the price keeps falling past the lowest point of the handle, your trade is now invalidated, so it makes no sense. So what you saw before would make no sense, so you need to get out of the trade immediately, and by having a stop loss below the handle will do this for you automatically. Since the handle must occur within the upper half of the cup, a properly placed stop loss should not end up in the lower half of the cup formation. Ideally, the stop loss should be in the upper third of the cup pattern. By having the handle and stop loss in the upper third or upper half of the cup, the stop loss stays closer to the entry point, which helps improve the risk to reward ratio of the trade. A trailing stop loss can be also used to get out of a position that moves up but then starts to drop again. However, this is a topic for another time. And just like other chart patterns, our profit target is deduced by measuring the height of the cup and then adding that height to the breakout point of the handle. The cup and handle pattern has many advantages. This pattern tends to have a great risk to reward ratio. The bottom of the cup is a stabilizing period where the price moves sideways. This means that the price found a good support level and that it couldn't drop below for some time. This can provide traders with a strong point to set a stop loss, which is also very helpful. The cup and handle pattern is also very easy to recognize once you become familiar with it. And since the cup and handle pattern is widely used as the basis for trading, it can also become a self-fulfilling prophecy. This is a very common term in trading, self-fulfilling prophecy. It means that so many traders are looking at this pattern that it almost makes itself happen because you see it and act upon it, and millions of other traders also seeing it and also buying and acting upon it. It almost makes the price go up anyway. This is what self-fulfilling prophecy means. There are limitations, as with other indicators, chart patterns, literally everything with trading. One of its limitations is the ambiguity of the pattern formation. Cup shapes, heights, and price targets can differ greatly. If you're going to use this pattern, you'll have to accept the discrepancies. Trading off this pattern requires patience and a rational approach to the market, something that is a challenge for many new traders. We also have the inverted cup and handle pattern. And all it is the opposite of the cup and handle pattern. It's an upside down cup with a handle. All the rules apply that we've mentioned for the inverted cup and handle pattern, but they're reversed. The inverted cup and handle pattern is a bearish continuation pattern or bearish reversal. In conclusion, the cup and handle pattern takes a while to form. That's why it's important to see the patterns within the patterns. As you're waiting for the handle breakout, take advantage of the other trades you can make. Meaning, there might be another currency pair with a momentum pattern that is happening now. Sometimes it's good to wait and not take a trade while we wait for our setup to come together. Being patient is one of the hardest parts in trading. And once you have mastered this pattern, it's easy to find the opposite pattern, the inverted cup and handle pattern.